Hey there, and welcome. Ever stop to think about how a massive company decides to pull the trigger on a new multi-million-dollar project? Well, it almost always boils down to one single critical number. It's cost of capital. Today, we're going to break down exactly what that is, the true cost of the money a company uses, and why it's the ultimate hurdle that every single investment has to clear. All right, let's just jump right in. I want you to imagine you're the boss. You're sitting in the big office. A proposal lands on your desk. It says, spend $50 million right now on a new warehouse, and it'll save the company $12 million a year for the next 6 years. I mean, that sounds pretty good, right? But here's the real question. Is it good enough? To answer that, we need a benchmark. We need a financial hurdle rate. And that hurdle, that's the cost of capital. This is the key that unlocks the whole problem. You can think of it like a minimum passing score for any investment a company is thinking about making. If a project can't promise a return that's higher than this rate, it just doesn't make the grade. Simple as that. So what is this thing really? At its core, the cost of capital is the minimum return a company has to earn just to keep its investors happy. And that means everybody, from shareholders who own a piece of the company to the banks who lent it money. It's really the opportunity cost of that money. See, by giving their cash to your company, those investors are giving up the chance to put it somewhere else. So your company has to earn at least this much to make it worth their time. Now, to actually calculate this all-important hurdle rate, we have to first figure out where a company gets its money. And, it basically comes from two main buckets. Equity, that's the money from its owners, the shareholders, and debt, which is just money it's borrowed from lenders. And here's the key. Each one of those sources has its own unique cost. So let's start with equity. This is all about what the owners, the shareholders, demand in return for putting their money into the company. Now, since they're the owners, they're taking on the most risk, right? So it makes sense that the return they expect is usually higher than what the lenders are asking for. So how on earth do we figure out what that cost is? Well, truth be told, there's no single perfect formula. It's a bit of an art, but there are two really common ways to get a solid estimate. There's the dividend growth model, which is great for stable companies that pay dividends like clockwork. But more often, you'll see people use the SML approach, also known as CAP, M. What's cool about this one is that it directly factors in a stock's riskiness, what finance pros call its beta. You can just think of beta as a measure of how much a stock zigs and zags compared to the overall market. All right, that's one half of the puzzle. Now let's tackle the other side, the cost of debt. This is what the lenders require. Now this one is a bit more straightforward to figure out, but it also comes with this really cool little twist, thanks to the government. First off, a super important point. The cost of debt is not the interest rate on some old loan the company took out years ago. No way. It's the interest rate the company would have to pay if it borrowed new money today. For big companies, you can usually just look at the current yield on their bonds. That tells you what the market is demanding right now. Okay, remember that twist I mentioned? Here it is. It's called the tax shield. And it's a huge deal. Because companies can deduct their interest payments from their income, they pay less in taxes. It's almost like the government is giving them a coupon for using debt. So if a company borrows money at 10%, but its tax rate is 21%, the real, actual after-tax cost of that debt isn't 10% at all. It's only 7.9%. That makes debt look a lot cheaper, doesn't it? Okay, so now we have our two main ingredients. We've got the cost of equity, and we have the after-tax cost of debt. Now it's time to put them all in a blender and create one single, incredibly powerful number, the weighted average cost of capital, or as everyone calls it, the WACC. To blend them properly, we just need to know the recipe. What's the company's mix of debt and equity? We call this its capital structure. For our warehouse example, let's just say the company is funded 75% by equity and 25% by debt. These are going to be our weights for our weighted average. And that brings us right to the formal definition. The WACC is really just what it sounds like. It's the average cost of all the company's money weighted by how much of each type it uses. It's the one true blended cost of capital for the whole company. So let's actually run the numbers. You take the equity part, it's 75% of the mix, and it costs 20%, so its weighted contribution is a flat 15%. Easy. Then you take the debt part, it's 25% of the mix, and its cheap after-tax cost is 7.9%. That gives you a weighted cost of just under 2%. You add those two numbers together, and there it is. Our WACC is 16.98%. That is our hurdle rate. So we did it. We found our magic number, 16.98%. This is the absolute minimum return this company needs to make on its investments to create value. So now we can finally go back to that $50 million warehouse and make a decision. So how do we do that? We use a tool called net present value, or NPV, and it's based on a really simple idea we all get. A dollar today is worth more than a dollar tomorrow. So we use our 16.98% WACC to discount all those future savings, basically to pull them back into today's dollars to see what they're really worth. And when we do that, we find out those 6 years of savings are only worth about $45.85 million in today's money. Now, let that sink in. We would be spending $50 million today for a project whose future benefits are only worth about $46 million today. The NPV is negative $4.15 million. This project does not clear the hurdle. The math is screaming at us, do not build the warehouse. It would actually destroy value for the company. Okay, so case closed, right? Well, not so fast. It would be really easy to just stop here, but there is a massive expert-level warning we absolutely have to talk about. Because while the WACC is an amazing tool for an average project, using it for every project can be a really, really dangerous mistake. Here's the thing. The WACC reflects the risk of the entire company on average. But what if a new project you're looking at is way, way riskier than your normal business? Or what if it's much safer? If you use that one-size-fits-all average number, you could be making a huge mistake. Think about it like this. Using a single WACC for everything is like setting the high jump bar at the exact same height for every single person. But that doesn't make any sense, does it? In reality, the bar needs to go up for riskier projects. The more risk you take on, the higher the return you should demand to make it worthwhile. And this is where things get really bad. When you use one hurdle rate for everything, you start making two critical errors. First, you start rejecting perfectly good, safe projects because their returns fall just short of your too high average hurdle. But what's even worse, you start accepting really risky projects because while their returns might beat your average hurdle, they aren't nearly high enough to justify the huge risk you're taking on. And if you keep doing that, over time, your company gets riskier and riskier. So the big takeaway here is this. The WACC is the starting point, not the finish line. It's the perfect tool for projects with average risk. But for everything else, you have to be smart and adjust. And that leaves us with one final big question to chew on. Is your company's hurdle rate helping it make smart decisions, or is it accidentally pushing it to take on all the wrong kinds of risks?